Investing used to feel like this exclusive club, kind of like a fortress with high walls guarded by expensive fees and, I don't know, secret handshakes. But over the last 20 years or so, those walls have completely crumbled. It's way more open, it's accessible, and for a lot of us, it's finally something we can actually do. We're going to explore this massive shift by looking at two very different stories. And we'll start with one that's a tough but really important lesson.
Wow. I mean, this one sentence, it's like a ghost story from that old world of investing. It just speaks volumes about the kind of risk, the desperation, and honestly, the terrible advice that shaped an entire generation. So who is he, and what on earth happened next? Let's find out.
So the he in that story, well, he was the father of a financial educator named Thomas Keele. His experience is this really stark reminder of what investing was like before the internet, before we had all the tools and information that we pretty much take for granted today.
Okay, so picture this. It's the pre-internet era. If you wanted financial advice, you were probably talking to an insurance salesman or paying a ton of money for some guru seminar. This was the world Thomas's father was trying to figure out. At 50 years old, he gets promised this quick path to wealth through something called mutual funds, which are basically these baskets of stocks managed by so-called professionals. And he bet the farm, or in his case, his parents' actual home. And then, the dot-com bubble burst. With no real knowledge and no community to turn to, he just panicked. He sold everything. And in doing so, he locked in these absolutely devastating losses. It was a complete financial nightmare. Look, this wasn't just a personal failure. It was really a systemic one. He didn't have access to good information. He trusted advisors who led him down the wrong path, and without a solid strategy, he made choices driven purely by fear. His story is the story of hundreds of thousands of people. But thankfully, the story doesn't end there. Things were about to change. Big time. That personal disaster actually sets the stage for a revolution. The entire financial world was about to get turned completely upside down, and it was all driven by technology and a new generation's demand for transparency. This slide just says it all, doesn't it? Back in the 2008 crash, investors were totally isolated, just paralyzed by fear, watching the markets tank on TV. There was no one to turn to. Now, fast forward to the pandemic crash in 2020. It was a completely different world. Young investors didn't see an apocalypse, they saw an opportunity. They were flocking to YouTube live streams and online forums, not to panic, but to learn and to act. So when the market tanked by 30% in early 2020, this new generation saw a massive sale. It was their chance to get in, to buy stocks on the cheap. This crisis actually launched millions of new do-it-yourself investors. So what changed to make all this possible? Well, the answer really lies in three fundamental pillars that have completely reshaped the entire landscape, creating the era of the do-it-yourself money manager.
It all boils down to these three things. Knowledge became free, gurus were replaced by communities, and the tools you need to invest became shockingly cheap. Let's break each one down.
First up, knowledge. You remember those super expensive seminars Thomas's father went to? Yeah, those are pretty much a thing of the past. Today, a single YouTube video explaining how the stock market works can get millions of views. You can flip from your workout playlist straight to a finance podcast in the same app. Quality financial education is finally free. Second, community. Instead of relying on some single guru up on a stage, we can now learn from the collective wisdom and, just as importantly, the mistakes of thousands of our peers. On places like Reddit or Discord, people are openly sharing their investment stories, their wins, and their losses. This kind of applied knowledge is absolutely invaluable because you get to learn from other people's experiences before you risk your own money. And third, cost. This might be the biggest game changer of all. Back in the day, buying the kinds of funds his father did meant going to a physical office and paying a commission that could cost thousands of dollars. Even just a decade ago, a single trade could set you back 20 euros.
And today, the brokerage fee is often free. Zero. Nothing. This total collapse in costs means you can start building experience with a tiny budget, maybe 50 euros a month. The barrier to just getting started has completely vanished.
And this whole cost revolution was fueled by tools like the ETF. They were originally just for the pros, but now ETFs give you instant diversification across hundreds or thousands of companies for a tiny, tiny fee. They're built for performance, not for slick marketing, which makes them perfect for the DIY investor.
Okay, so the why is clear. The world has changed. Now, let's get to the how. How do you navigate this new world and, as Thomas Keele puts it, not mess it up?
It really boils down to these four simple but incredibly powerful rules. First, use all those free resources to learn the basics, like diversification and keeping your costs low.
Second, always follow the money. Third, be skeptical. And fourth, don't be afraid to make mistakes.
Let's dig into rule number 2 for a second. Follow the money is all about spotting conflicts of interest. So when a bank advisor is pushing a certain product, just ask yourself, who really benefits here? Is it me, or is it the bank that needs to sell its own expensive funds? This one question can save you from a world of bad advice. Rule number 3, skepticism is basically your superpower. If you hear about a once-in-a-lifetime opportunity that has no risk and high reward, run. It doesn't exist. You got to be wary of these so-called financial innovations like buy now, pay later, or those gamified trading apps. A lot of times, the real innovation isn't the product itself, it's the marketing that's designed to make you spend or trade more.
And here's why that skepticism is so crucial. When it comes to day trading on those flashy apps, the numbers are grim. Over 80% of retail traders lose money. The more you trade, the more the broker profits, and, well, the more you stand to lose.
And finally, rule number 4, don't let fear paralyze you. The best way to overcome that hesitation is to just start small. If you're nervous about investing, say, 5,000 euros, that's totally normal, so don't do it. Start with a 50 euro monthly savings plan instead. The goal here is to apply what you've learned, gain some real-world experience, and build your confidence over time.
So the crucial point here is that taking control of your own finances is one of the most impactful decisions you can possibly make. And all the old excuses, they're gone.
You know, it used to be that the biggest risk was getting bad advice or paying sky-high fees. Today, with all the knowledge, all the community support, and all the low-cost tools right at our fingertips, the biggest risk is simply doing nothing at all. You've got everything you need to get started.
We started this whole thing with a cautionary tale, a story of a financial disaster. But now, with a completely new toolkit at your disposal, the question isn't if you can invest, but how you'll choose to. So what story are you going to write for yourself? The pen is in your hands.